All right, FAMA students, that's financial accounting and management accounting, welcome. Today we're going to get stuck into the really foundational concepts, accounting, bookkeeping, and importantly, this isn't just any overview. We've shaped this with insights directly from your module leader and tutor for the financial accounting side of things, Salah Hamad. So think of this as a helpful study aid, really, designed to get you started. Because, accounting, it's so much more than just a number, isn't it? It's often called the language of business. And honestly, if you want to properly understand how any organization works, how it succeeds, maybe where it's struggling, you really need to get a grip on this language.
That's absolutely right. And like any language, you start with the basics, the grammar. So in this session, we'll look at the history, the surprisingly old history of accounting. We'll explore its key functions, its main objectives, demystify some of that core terminology, assets, liabilities.
Okay.
We'll look at the different kinds of business structures, the entities, and finally touch on the regulations that sort of shape everything. It's about building that solid foundation first.
That sounds like a great plan. When you say ancient roots, I immediately think, well, not of spreadsheets, more like old clay tablets or something. What was the actual need? Why did people start accounting for things way back then? Was it just about money?
It's a great question. And no, not just money. Think about ancient merchants tracking goods or armies tracking supplies. The need to know what you have, what you owe, what you've used. It's fundamental to organizing anything complex. It's really about control, trust, and planning. Without some system, things would just fall apart. Which brings us neatly to the nature and functions of financial accounting. Broadly, you can think of it in two parts. First, there's the recording control function. This is the really detailed bit, keeping accurate, systematic records of every transaction.
The day-to-day bookkeeping, essentially.
Exactly, but it's more than just listing things. It's about protecting the business's assets, the cash, the equipment, making sure it's all there. It's also about legal compliance, tax rules and things, and making sure transactions are genuine, properly authorized. It's the bedrock, the proof.
Okay, so that's the recording part. What's the second function?
The second is the reporting function. This is where you take all that recorded data and turn it into useful information. You provide this financial information to different people, stakeholders we call them, inside and outside the business.
Why do they need it?
Well, simply put, for making economic decisions. How else does an investor decide where to invest, or a bank decide on a loan? They need reliable information about the business's performance and position.
Right, so the reporting isn't just numbers on a page. It sounds like it's about accountability. I've heard the term stewardship accountability. Does that fit in here? The idea that managers have to report on how they've looked after the resources they were given?
Precisely. That's a key concept. Management are stewards of the owner's resources, and they have a duty to account for how they've used them. Stewardship accountability is a big part of the why behind financial reporting.
And is that the main difference between, say, financial accounting and management accounting, who the report is for?
That's a major part of it, yes. Financial accounting, which is our main focus here, is primarily for external users, investors, lenders, regulators. Management accounting is geared towards internal users, managers within the business making decisions about things like production levels, marketing spend, investments.
Okay.
So management accounting information might be more detailed, perhaps more forward-looking, and doesn't always have to follow the strict external rules. Its job is to help run the business day-to-day effectively.
That makes sense. Different audiences, different needs. So let's focus back on financial accounting then. What are the objectives of an appropriate accounting system? What's it ultimately trying to achieve?
Good question. The core objective is always to provide information that helps users make informed economic decisions. That's paramount. It also helps users assess how well management has done its job, that stewardship point again, and gives feedback on how the business is actually performing financially. Is it profitable? Is it stable?
And for that information to be genuinely useful, it needs certain qualities, right?
Yeah, absolutely. There are key qualitative characteristics. The information needs to be reliable, so trustworthy, free from major errors or bias. It has to be timely. You can't make good decisions based on old news. It must be relevant. It has to actually matter for the decisions being made.
Okay.
And it needs to be understandable by the people it's intended for. And crucially, comparable. You need to be able to compare a company's performance over time or compare it with other companies.
Right. Without comparability, the numbers don't tell you much in isolation.
Exactly. These qualities are what give financial information its value.
You mentioned earlier that accounting is like a language. I find that a really helpful way to think about it. It communicates the story of the business. So, what are the basic words or elements of this accounting language that students need to get familiar with?
Yes, the language analogy works well. And the core elements are the building blocks you find in the financial statements. Let's start with assets. Simply put, assets are resources the business controls because of something that happened in the past and from which it expects to get future economic benefits.
So, things it owns or controls that will help it make money later.
Pretty much, yes. The formal definition is key, though. Resources controlled by an entity as a result of past events and from which future economic benefits are expected to flow. Examples. Things like furniture and fixtures, maybe machinery or amounts due from a customer. That's money owed to the business. An asset.
Okay, got it. What's next?
Liabilities. These are sort of the opposite of assets. They represent future sacrifices. They are present obligations, again arising from past events, and settling them means an outflow of economic benefits, usually cash.
So, what the business owes to others.
Exactly. Things like loans from a bank or amounts owing to a supplier for goods or services received but not yet paid for. Those are liabilities.
Right. Assets and liabilities. What else?
Then there's ownership interest, or equity. This
Yeah.
is what's left over for the owners. Formally, it's the residual interest in the assets of the entity after deducting all its liabilities. So assets minus liabilities equals equity in its simplest form. It's the owner's stake.
The net worth from the owner's point of view.
Precisely. And then finally, we have income and expenses. These are about performance over a period. Income represents increases in economic benefits, usually from selling goods or services. It's not just cash received, it's the value generated. Expenses are the opposite, decreases in economic benefits. The costs incurred in generating that income, like paying salaries, rent, buying materials.
And the difference between income and expenses gives you profit or loss, right?
That's the bottom line, yes. Understanding how these five elements, assets, liabilities, equity, income, expenses, fit together is absolutely fundamental.
Okay, so those are the building blocks, the words of the language. How are they put together to tell the story? What are the actual reports people see? The annual report and financial statements.
Right, these elements are assembled into the main financial statements. These are the primary output. For companies, the published set usually includes several key parts. First, the statement of profit or loss and other comprehensive income, or just statement of profit or loss for simpler businesses like sole traders. This shows your income and expenses over a period, usually a year, and tells you if you made a profit or loss.
So performance over time.
Exactly. Then there's the statement of financial position. This is different. It's a snapshot at a specific date. It lists the entity's assets, liabilities, and equity at that point in time, like a photo of financial health.
Okay, snapshot. What else?
You also have the statement of changes in equity, which tracks how the owner's stake changed during the period, and the statement of cash flows, which is really important. It shows where cash came from and where it went. Profit on paper doesn't always mean cash in the bank.
Right, cash is king, as they say.
Indeed. And supporting all of these are the notes to the financial statements. These are vital. They give extra detail, explain the accounting policies used, and clarify the figures in the main statements. For companies, these are often bundled into an annual report sent to shareholders. The ultimate goal, to present a true and fair view of the company's finances.
That true and fair view sounds important, but maybe tricky to achieve perfectly.
It involves significant professional judgment, absolutely. Which leads us nicely into the idea that different types of businesses might have slightly different rules or focus.
Understanding these types of entity must be pretty crucial then.
It's fundamental. The legal structure impacts everything accounting, tax, and especially the owner's liability. Let's quickly cover the main ones. First, the sole trader. One person owns and runs the business. Crucially, there's unlimited liability.
Meaning the owner's personal assets are at risk if the business fails.
Exactly. House, car, savings, all potentially on the line. And legally, the owner and the business are considered the same entity.
Okay, what about partnerships?
A partnership involves two or more people carrying on business in common with a view of profit. Often, like sole traders, partners also have unlimited liability, although there are some variations like LLPs. But traditionally, personal assets are at risk.
Shared risk, shared reward.
Something like that. Then we have the company. This could be a private limited company, LTD, or a public limited company, PLC.
The absolute key difference here is it's a separate legal entity.
Meaning it exists apart from its owners.
Precisely. The company itself owns assets, makes contracts, pays its own corporation tax on profits. And the really big point, shareholders usually have limited liability.
Ah, limited liability. That seems like a huge deal. They can only lose what they invested in shares, right? Not their personal wealth.
That's generally the principle, yes.
Yeah.
It's a massive difference from sole traders or traditional partnerships. It encourages investment and risk-taking because the personal downside is capped.
That protection really underpins a lot of modern business, doesn't it? It really does. And this need for clarity, especially with companies dealing with public investors, brings us to the regulatory framework of accounting. Why do we have all these rules and standards? Well, it's primarily to protect stakeholders, investors, creditors, employees, and ensure they get information that is useful for their economic decision-making.
So it's about trust and consistency.
Exactly. Without a framework, it would be chaos. You couldn't compare companies reliably. A major player here is the International Accounting Standards Board, the IASB. They develop global standards, International Financial Reporting Standards, or IFRSs.
And lots of companies have to use these.
Yes, particularly listed companies in many parts of the world, including the EU. Using IFRSs aims to make financial statements comparable across borders, which is vital for global investment and trade. It promotes transparency and trust.
So that framework provides the rules of the language, essentially.
A very good way to put it. So just to recap this first deep dive, we started way back with the historical roots, the why of accounting. We looked at its dual functions, recording and control, and then reporting. We clarified the objectives, decision usefulness, stewardship. We unpacked the core language, assets, liabilities, equity, income, expenses. Then we saw how these build the financial statements, profit or loss, financial position, cash flows. And finally, we distinguished between different business entities, sole traders, partnerships, companies, and touched on the vital regulatory framework, like IFRSs, that governs it all.
That's a fantastic summary. It really feels like we've laid down the essential groundwork. And as Salah Hamad, your module leader, would stress, really getting to grips with these fundamentals now will make everything else in the FAMA modules so much easier.